whether you're an aspiring or emerging co-GP or a limited partner, if you don't know enough about the people that have worked with them in the past, that can be a recipe for disaster. So I'd be very careful about that when you're looking for people to team up with.
Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. Listen, if you're enjoying this show and getting good feedback for your real estate investing journey, make sure you leave us a rating and review. We want to hear from you. We also want to understand what's working for you, but also take any feedback that can help us make this show work harder for your investing goals. And if you haven't done so already, man, this is your time. Hit that subscribe button so you don't miss an episode. We've got a fun show today. We're going to be talking to Ruben Greth. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmancapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to casmancapital.com and click on the Mastermind button today. Ruben Greth has been scaling in heavy lift departments in value-add multifamily syndications since 2019. Now, he started as an apprentice with a Phoenix-based operator, and he has since found his niche working with and developing co-GB partnerships. And he is a syndicator, co-general partner, and a subdivision developer. Let's welcome to the show, Ruben Greth.
Honored to be here, John. Really cool to kick it with you. You were actually recorded on the Capital Raiser Show, which is my podcast, way back in September of 2019, episode number 8, believe it or not, dude. So it's been fun kicking it with you for that period of time, man.
I love it, man. Episode 8, we'll definitely have to make sure we link to that. And you're right, you are the host of the Capital Raiser Show, and you've had a great success on that show. And I kind of went over your bio at a very high level. Why don't you take 2 minutes and fill in some of those gaps?
All right, I'll go quick, man. I got my start in capital raising for small fourplexes back during the real estate crash of '08 in Phoenix, where we were buying fourplexes for absurd amounts. I'm talking about like a house with a threeplex in the back for $72,000. So we did a bunch of threeplexes, fourplexes, a 12plex. We had a 42 unit under contract. This is me and my partner, Ivan Navarrete, way back in the day. And then he and I didn't see eye to eye on a couple of marketing things. So we split up. I went back into corporate America with my tail between my legs, could not work for a company for the life of me. I just can't be leveraged by somebody else. So I dipped down into Mexico for a year, met my wife, came back to the United States. All I knew was fourplexes, tried to get back in the game, told somebody I wanted to buy 32 fourplexes. They did the math. They're like 128 units. Why don't you take them down right now? And I'm like, what? I don't understand how to do that. So they introduced me to the concept of syndication, got very interested in that, had some money that was coming to me. And I was like, I'm going to spend this money on a mentor, but let me find out what a syndication company is all about, who I need on my team. Talk to my broker that sold me all the fourplexes back in the day. And he's just like, I know somebody that I sold a $5 million property to. Why don't I set up a meeting with them? I went to them in their office and asked them, who do I need on my team? And they're like, well, what do you care? I'm like, well, I used to raise capital for fourplexes back in the day. I created a YouTube channel and raised all my money off social media. It wasn't exactly offering to just to understand compliances. Like I wasn't offering returns or anything. I was just telling people my business model. We raised like $625,000 for fourplexes. And they're like, come on board with us. I raised about $1 million for them. Started the Capital Raiser Show. I wanted to learn, this is why I interviewed you back 4 years ago. Like, how do you raise money from limited partners? And, I started hearing things like, you don't raise money, you attract money. You don't focus on yourself, you focus on the investor. And this podcast opened up this universe and can of worms of capital raising that went from limited partners to raising from preferred equity and joint ventures and family offices and institutions and all these creative finance strategies and funds. And can you actually raise capital with your first fund? And I was like, wow, this is such a crazy business. I didn't know that this is such a huge universe that I just stepped into. I decided to leave that company to launch my own fund because I had interviewed all these people like yourself that were doing business all across the country, and I wanted access to your deals. And that's when I met my previous partner, Andy McMullen of Legacy Acquisitions. I helped him take his business from one virtual assistant and a couple of marketing guys to a full-blown private equity shop that had like multiple co-GPs, a COO, a marketing agency, a marketing manager, sales representatives. And over the last just a couple of weeks ago, man, I decided to leave them because it started becoming a corporate environment. And I had a lot of fund manager friends that were just kind of like one person teams and shops, and they were having a lot of fun, not operating, but just managing funds and hanging out with investors. And I decided, you know what, I think I'm going to take the leap and go off on my own and rebuild the business, which is kind of scary, but I'm a risk adverse. So I decided, let's do this. And now, like, because I have some friends in the family office club, including Richard Wilson, he's already introduced me to some people that I might hang my hat with. And this has been a crazy journey. In the process, working with Legacy Acquisitions, we got into build to rent. So we have 3 subdivisions, 98, a 158, and a 241 that we're still building, because even though you dissolve your relationship or your company, or you split off from them, you still have assets to manage, right? So I'm partnered with these guys, and I'm looking for build to rent operators here in Phoenix, and potentially some short-term rental guys and some other asset classes. And that's kind of how I got here in a nutshell. Super fast, I know, and there's a lot to dissect there, but this is where I find myself today.
Man, Ruben, I got to take a breath. That was so good, man. A lot of great stuff, dude. You talked about really getting your start with fourplexes and, using those fourplexes. That first one, you said you got a house with a 3-plex in the backyard for like 70-some thousand dollars. Just incredible in Phoenix at that time. But fast forwarded, really took that concept, went and got a corporate job, left that, went down to Mexico, met the woman who became your wife, came back, tried to learn how to do the fourplex thing again. And ultimately you found your way into apartment syndications, working with Andy at Legacy Acquisitions, and now off on your own. I want to take it back to when you launched Capital Raiser Show, right? Because you said, I'm episode 8. And I remember when you first launched it, we were getting started there, and you had so much energy, which you still have. And I think it's really interesting because of the personality. You talked about, before we hit record, you talked about being a risk taker, and understanding risk and risk tolerance. Talk to me about kind of your approach when you launched Capital Raiser Show. Did you hesitate? How much time did you spend thinking about it? Like,
None.
what was that process like launching the show?
So a lot of people suffer from analysis paralysis, and I'm the kind of guy that, like, if I need to have everything in a row, all my ducks in a row, like, I'll never get started. So I didn't know what I was doing. I decided I'm just going to jump off the cliff and learn to fly on my way down. I was introduced or found somehow a book by Joe Fairless called The Best Ever Apartment Syndication Book. I jumped right into the capital raising chapter, and he talked about starting an interview-based thought leadership platform. So I'm like, okay, I've done this before. I raised money from a YouTube channel. I haven't done the podcast thing, but it's got to be something similar, right? Let me go learn from like the best syndicators that I can possibly find. And I didn't know how many of them existed, because I used to have this limiting belief that like multifamily partners don't grow on trees. And then I would look at other syndicators and podcast hosts like Corey Peterson and Michael Blanc. And like at the end of each of their shows, they always gave the contact information of the syndicator. I'm like, these guys actually do grow on trees. So I was like, I can find these guys, interview them, take their best practices in psychology, syndication, law, and then implement some of these things, I think, over time. And I figured this, if I can learn and master this capital raising thing, I knew one thing for sure, is that my services would always be in demand. So this was my whole concept. The show was very green in the beginning. Like, I didn't know what questions to ask a syndication attorney or what a K1 is. I didn't even know if they were the ones that I was supposed to ask that question to. Apparently not. I should be talking to a CPA, but they kind of explained, raising capital, fund structures, syndication, the difference between a syndication and a fund, etc. And over time, I just got more and more education. And because of this curious attitude, I just wanted to learn and absorb everything. And I had been to many conferences where people spoke about how they got into real estate syndication. And I've just felt like unfulfilled. Like I didn't really get the answers to how to become a syndicator from your 25-minute presentation. I need to talk to these guys and find out how they negotiated, how they built their teams. And I was so curious about how to do this. It's like everybody that was listening to the show that, from some of the greatest sponsors in the country were learning with me. And I think that's why it became wildly successful, extremely fast. And people were calling me like the Titan of capital raising, like way back, like in episode 20 or 30. I'm just like, dude, I don't know crap. How could you call me that? But it is because I surrounded myself with some really powerful syndicators and got them to agree to an interview right off the bat. And, just that you can learn a lot from just that, is like hang out with the most intelligent people versus hang out with people at your level.
I think there are really some excellent insights from what you just said. The first one I want to say is taking action, right? You realize there was some information out there. You read the book, you jump straight to the chapter on capital raising. The book, of course, is the best ever apartment syndication book by Joe Fairless. You jump straight to that chapter. You understand that you want to create a thought leadership platform, particularly an interview-based thought leadership platform. And that's exactly what you did. And I think that the other thing that jumps out to me is that our experiences in life stack up, and you never really know how they're all going to intertwine and work together. But I think part of the reason you were comfortable doing that is you used to have a YouTube show, right?
Mm-hmm.
So you were comfortable leveraging social media. You have proof that for yourself, leveraging social media, leveraging content to attract investors has worked. And then you get a guy like Joe Fairless in his book telling you this is exactly what he did. So it was an easy, I don't want to say sell, but you were convinced right away that this made sense. Let's go out there and let's create this. The next step for you is obviously to find these people, interview them, and not just pick their brain, but have a value exchange where you're creating the platform, you're letting them get their message out, share what they're doing. You're getting great feedback and great nuggets of insights. And over time, you are now growing into a great capital raiser and someone who is a great investor because you're learning from some of the best minds in the industry. And I think the insight there is, one, take action. Two, there's proof in the blueprint. So follow someone who has that blueprint because that's going to allow you to be successful. You've talked about a couple things. I'm going to go a couple of places. So I want to figure where I want to go first, right? Let's talk about the show more, right? So the Capital Raiser show, you're still pumping out content now and episodes. Where's the show at today? How many episodes are you doing? And what do listeners get when they tune into the Capital Raiser show?
So I've had a lot of feedback from people saying like, I learned how to syndicate from listening to your show, which is kind of crazy. I love all of the messages that I get. I get a lot more of those than actual reviews, but that is proof to me that the stuff that I'm trying to learn from these syndicators is valuable information that people can take from, and it's free, right? So I think those are some of the things. Today, as it stands, I've recorded probably about 300 individual one-on-one interviews and done some special series, including, let's see, technology and capital. I did a Build Your Legacy webinar series that also got released as special educational content on the Capital Raisers show. I did one called Mind Magic, was just me sharing mindset concepts with people. The Raising Money Mentor with Kate and Patel, and also the Raising Money Minute series that I did with Annie Dickerson, where it was half mindset, half strategy. So I've done all these series. Altogether, I've released close to 700 pieces of content, including previews. I have about 2.8 million downloads, and I'm ranked on listennotes.com in the top 1.5% of all podcasts globally, which sounds like it's amazing, but a lot of syndicators, including yourself, I haven't checked, but I think you're in the top 1% or something of all podcasts worldwide too, right? So there's a lot of syndicators that get success because people are hungry for this knowledge.
Yeah, I love all that, right? So lots of content, lots of information, 2.8 million downloads. So you're obviously connecting with people in a way that they're looking for and giving them the information that they can use to be successful. What do you think, is the draw, right? There's not just one multifamily investing show. There are lots of shows out there. Why do you think your show stands out and is so successful?
I drink Rockstar Energy before every podcast, and I'm just like flying, right? So part of it is like, dude, some of my least downloaded episodes are guys that have like raised $200 million and they're just flat and dry and they're
Yeah.
boring, right? So the whole concept of podcasting is like, I want to tune into something while I'm mowing the lawn or washing the dishes or taking a drive, and I want to be entertained, right? So I think some of my energy is entertaining, and it's simultaneously satisfies people curiosity. People are trying to better themselves and get educated in the syndication space, and particularly this particular niche called capital raising, which there's not a lot of programs out there, or at least when I started, there wasn't a lot of capital raising mentorship or guru programs specifically out there to teach capital raising. So I think for all of those reasons, the show has been kind of successful.
Man, I think it's really great insights, right? Because part of it is understanding that you want to launch a thought leadership platform, but you also want to grow it, right? You want to see the feedback, you want to get the downloads, you want to see, all that positive feedback. And one thing that you do well is understanding the medium, right? And I think this goes back to your time on YouTube as well. There's a certain energy that you need to bring to it. There's other things like that you need to really stand out. And I think you understand that better than most people. I would also say that one thing I've noticed, at least, is part of it's energy, but part of it's relatability too,
Mm,
right? Like, I don't think you've ever tried to come across as the expert,
no.
right? You're relatable because you're learning just like your listeners, and you're asking very inquisitive questions, and you're okay being somewhat vulnerable in that space, and not, like you said, right? Hey, I'm asking questions, and maybe I should have asked the CPA and not the attorney, but I didn't know, whatever, right? And I think there's it's great as a listener because you can see, they can see themselves in you as they're watching you on that journey, right? And I think other people, particularly if you're more established or seasoned, they are trusting you to be kind of the expert. So it's a little different interview balance when those conversations are having. So I think that's something that you do really well. Just to give a compliment, because I love the show, and I think that's something that stands out when I listen to you on your show.
I appreciate that, man. And I think another little piece that was very insightful, what you were just mentioning. I think another part is like to interview people at different stages of the game. Right now, you're interviewing me as I'm transitioning. I interviewed Brian Briscoe right when he left his company and he was
Yep.
launching his first fund, to step into the mindset of what's going on with the human being, because we're all just regular dudes or ladies at the end of the day. And if you can kind of dive into like how they're navigating all of this adversity and complexion and like establishing businesses and growing and scaling companies, and find out like, let me talk to the guy that's raised a few $100,000 and see where he's at in his journey and what he's had to go through. It's fresh for that person. You talk to somebody that's raised $200 million, they can't even remember what it was like in the early days, right? So it's a hybrid of getting people the right information, but it's also like stepping into their mindset, their psychology, what's going on with them, how are they breaking through their limiting beliefs? Because a lot of people that are getting into the syndication game, they've never raised money, or they've never bought a 5, 10, 25, $45 million property, and nobody in their family has either. So like, what gives them the right to go out and be a syndicator? Those are the kind of questions that are very complex, that I really love to dive into the psychology and find out how they're navigating through those periods of time.
I love it, man. Well, listen, we'll make sure we put a link to that. If you want to learn more, you can always check out Ruben at the capitalraisershow.com. Hey, I want to pivot and talk about one of the
Yeah.
markets you're spending a lot of time in, right? Phoenix. Phoenix is one of those markets that tends to go, really well. It has been one of the darling markets over the last few years. The market shift is starting to impact it. What are you seeing in the Phoenix market today?
So I'm just getting back into the Phoenix market. I've lived here my entire life. I've seen it to be more of a West Coast, dramatic increases, dramatic decreases in terms of appreciation value, rental increases. I think it's more of a roller coaster ride than, if you look at the Midwest or a place like Texas. Florida, Nevada, California, and Arizona have been these markets that have incredible dips. And what I'm really kind of paying attention to right now as I'm working my way to get back into investing in my backyard is as I reflect on the last 10 years of syndication, there's been a lot of people that have made a ton of money without really solid business plans here, just based off of the increases in rents and the amount of syndicators that have moved into this space, particularly the Californians who don't live here, but they don't want to invest in Florida because it's only, an hour and a half flight to get here. And there's some operators that even in a decreasing rental market, they're still having rent increases. And these are the people that I'm most interested in, because these are the guys that have solid business plans, that have not had to do capital calls in this economic climate where interest rates have gone crazy, because their business plans were solid and they underwrote correctly and they used right leverage and the right loan product, typically not bridge debt, not some kind of adjustable rate or some kind of financing that would put people into precarious situations, or they've leveraged a small amount against the property, like 60%, 50%, which means that they have to raise more capital, but it's a lot safer investment. So those are the guys that like I want to mimic and model myself after, whether on the construction and development side, because I just went to a 48 unit site earlier today with some friends that have been building fourplexes, and now they're scaling, and now they're building bigger and bigger stuff. And I'm trying to network with build to rent operators here. It's a very different business model. Land is more expensive. Construction is more expensive here in Phoenix versus where I'm currently investing, where we have our subdivisions in Louisiana, where, in Alabama, where dirt is extremely cheap and the cities are in pro growth mode and they're very lucrative. But, for somebody like you or me that really focuses on marketing and branding and raising capital or attracting capital, as you prefer to say, it is a completely different business model. And, like our friend Hunter Thompson likes to say, you may have a cow farm that has a 50% return on investment, but you'll never get an investor because they just don't understand that business. And for a capital raiser, if you're raising for stuff in secondary, tertiary markets where none of their cousins, friends, or neighbors are investing, and they don't have trendy limited partner friends that they can bounce ideas off of and say, hey, we should invest in these kind of smaller markets because it's more lucrative, they'll still say no. So I'm really excited about Phoenix right now, because even though there's some people like Neil Bawa saying it's super saturated on the construction side, and there's some other operators that are having capital calls and they didn't have the correct business model, I know that money can be made in this market. And it has been a mecca for real estate investors for multiple decades. This is where Robert Kiyosaki lives, and like some of the hugest gurus. A lot of people are moving into this town. There's a lot of opportunity here. I mean, especially in the coming years, because people will be having their loans reset, and there's going to be some blood in the streets and some opportunity to buy some multifamily. If multifamily is your gig, I think Phoenix is going to be a great place to invest. I'm more focused on the development and short-term rental side. So I think Phoenix, because it's a landlord-friendly state, is going to provide a lot of opportunity for the things that I'm interested to, in addition to the multifamily that I talked about a little bit earlier too.
Hey, Ruben, I appreciate you breaking down the market. I think you're spot on when you talk about kind of the boom or bust cycles. And that's one of the things that is challenging for most investors, right? When things are good, they're great, right? They're phenomenal. I know at one point, I think it was last year, but I saw rent growth was like 20 to 25% or something like that, which is just astronomical.
Mm-hmm.
I think the challenge is that that's not sustainable. And typically, just to give a little insight for everybody, when you see numbers like that, it's usually driven by new construction, right? Because how else can you really get rents to go up that much if it's not a new property or a bunch of new properties that are coming to the market? I think sometimes people see that rent growth and it's harder for them to understand, like, well, everybody just went around and increased rent 25%. That's not exactly how it happened, but on the same note, you do see the overall rent growth being at 25%. So you have to ask yourself, well, how sustainable is that? Especially with the inventory coming on to the market there. But I like the fact that you talk about too, and this is true for every market, because if you fall into the trends and you're just trying to follow, what the buzz is, you're always going to be chasing, right? We're always a little bit behind. So I think it's important to have strong investing fundamentals. What do you believe in? What are you looking for? What are you trying to achieve with your investments? And then find markets, find opportunities, find sponsors, find deals that help you achieve those investing goals. For you, you still like Phoenix. You're going to be investing in Phoenix. You're looking at different deals. And you talked about focusing on deals where those operators are still having success and still driving rents, even where rents are going down. When you think about those deals or those operators, I know you talked about the loan aspect, but what other truisms are there that you see when you compare the deals that are performing today, especially in a market like Phoenix, versus the deals that are maybe in trouble?
Yeah. So I wouldn't call a lot of the operators mom and pop operators, but they're not these like conglomerates with incredible teams of multiple employees, maybe even become corporate kind of environments with incredible track records. One of the things that I'm looking for, you didn't hit on this particular thing, but as I'm vetting operators, I'm really looking for what is the track record, but beyond that, what is the investor retention rate? Like, what is their investor experience? If it is a really incredibly good investor experience and the communication infrastructure is phenomenal, a lot of these guys are going to be very excited and they're going to tell their friends about it. So the returns obviously are great, but I would say a lot of people are more interested in like, am I familiar with this? And do my friends invest in these particular markets? Right now, there's enough blood in Phoenix where people are pretty scared. I would say actually across the country, people are pretty nervous right now. And the reason that they're nervous is because a lot of these guys, these limited partners, they're not real investors, they're speculators, right? So when you can convince people and give them enough information, raw data, market analysis, and show that you are making money in this environment where some people are struggling, that kind of proves and provides social proof that you have been able to navigate this through building an incredibly powerful or well-developed organization from top to bottom that can navigate all of these economic problems that are frustrating investors all across the nation. So those are some of the things that I'm really interested in.
I think that's helpful to understand. And I think that's a great way to look at it. So again, markets are cyclical, but great investing philosophies, the fundamentals, those really don't change. So make sure you're asking the right questions when it comes to vetting those operators and vetting those opportunities.
Here's
I know
another
you,
thing. Here's another thing
yeah,
that I would say about that, because you come across some people that seem very sound spiritually. They take care of their residents. They're very good at acquisitions. They're very good at managing property. And then you end up doing business with them, probably in some cases not following your gut instinct, but just based off of what you're seeing and what you're hearing from them. And then you find out that they're very poor communicators, that they have some dissatisfied investors, that they don't have good retention rate. And you got to be, I think a lot of people are not careful enough to follow their intuition and do enough due diligence by talking to previous investors or getting some kind of previous, maybe a co-GP that's worked with them and finding out what their experience is, particularly newer investors, whether you're an aspiring or emerging co-GP or a limited partner. If you don't know enough about the people that have worked with them in the past, that can be a recipe for disaster. So I'd be very careful about that when you're looking for people to team up with.
Yeah, what I'm hearing you say is get referrals, right? Get references, understand the retention rate, which is essentially how many of their investors reinvest with them. What's the communication style? But just really getting a sense of like, how are they as an operator? And it's interesting because what you're alluding to or saying outright is when you're at the beginning stages, it's like dating, right? Everyone's going to put their best face on, right? Everyone's going to be very nice and cordial and all that stuff. But once you make that investment, once you're in business together, well, now you're in a serious relationship. And now you really want to get a sense. You will find out who they are, what they care about, how they operate, how they communicate. And that's probably too late to ask some of the tougher questions or to get some of the insights you're really looking for. So the best alternative is to figure out someone else who's already worked with that individual, understand what you can expect. And that should set you up for at least your own expectations. So make sure you ask those questions, get those references and make sure you prioritize the things that are important to you as an investor. You talked about build to rent, which I think is a phenomenal platform. A lot of people are doing that. You mentioned that you're seeing build to rent opportunities in areas where land is a little cheaper. I mean, more in the South, Mississippi and some of these different markets there. Um, is that kind of where you're focused right now, that in short-term rental as far as new construction and development? Or is there something that would kind of, I don't say make you, but is there something that would allow you to focus more on multifamily? Are you looking for a pendulum to swing, or are you just deciding right now
I'm
build to
following
rent is where
market
your focus?
trends. The
Okay.
biggest one that I'm seeing right now is there's an incredible shortage of housing. Some people approach it from like, how do we create more affordable housing? And other people will look for, well, how can we get people into homes? Right now, they're not buying. The sellers, number one, are not selling because they are locked into an incredible interest rate. So they don't want to sell their houses. And then the buyers are thinking to themselves, well, God, I'm hoping that the rates finally come down so my purchasing power will increase. And what do they do in the meantime? If there are these millennials that now have two kids and a dog, well, it's hard to fit two kids and a dog into an apartment. So they're looking for a home experience. They may not be interested in buying right now, but they still want to have a doggy door and a driveway and privacy. So I think build to rent solves a lot of that stuff, at least in the meantime, right? And because it's a home and not an apartment where somebody lives above you, below you, to the left of you, to the right of you, they tend to stay there on average twice as long, if not longer, 40 months versus 18 in apartments, according to Neil Bawa. They pay the most and default the least of any segment in the commercial real estate space. We do consider build to rent a commercial real estate asset. It's got some of the same benefits as multifamily. In fact, it is what we call horizontal multifamily. So it's got the same recession resistance, it's same tax benefits. It solves the housing need. There's massive demand from institutional people that want to have all of their houses in one place with one property manager and one leasing agent. So it's not this scatter site kind of stuff that you used to see back in the bulk REO days where banks had they were offloading all these houses. There's low maintenance because they're brand new houses, lucrative for everybody involved, including the general contractor. So, I think for all of these reasons, not to mention the fact that you're not competing with numerous syndicators all for the same property, driving the price up when there's already no spread. The nice thing about development is because it's harder, less people are doing it. So if you can find the right person that's already done a ton of construction and holds hands with them, then you can basically mitigate a ton of the risks. And depending on where you are raising capital, right? Because you need money for three phases: for the purchase of the land, for the horizontal infrastructure, which is streets, sewers, utilities, electricity, et cetera. And then there's the vertical development. So once the concrete slabs are in, this is where we like to syndicate, at least on our deals, because from the time that we take a slab of concrete and build a house on it, it can be like 2 months, right? So if you have 100 units, you can build those 10 at a time. And within 12 months, you have the whole subdivision complete. That's fast. That's mitigating the risk. A lot of people are afraid of development because, you have to go through all the land entitlements and wetland surveys and flora and fauna and archaeological studies. If somebody finds a bone on your land because they did a soil sample, all of a sudden you have to check to see if there's, Indian ruins or a cemetery there or something. Like all these things pop up in development. But if you can get rid of all of those phases that are a little bit crazier and just say, hey, we're all done with it. All we have to do is build the houses. We can get your money back in 24 months. We'll still underwrite it for 5 years because we don't want to underpromise, or we want to underpromise and over deliver. Then at that point, you've mitigated the risk. You're getting people their capital back, and it solves quite a bit of problems. But then, as the syndicator or fund manager or person that's putting these projects together, it can be challenging to raise in these phases. And even with bank loans, they give you money in tranches. Here's enough money to build 10 houses, or here's enough to build 20. And then there's things that happen where construction costs change, the price of concrete changes, the price of lumber changes, insurance costs change. And this is something that it freaks out most limited partners that are coming from the value add multifamily space because it's a lot more straightforward. So if you can find somebody that's willing to depending on what their goals are, if they're looking for a back end equity spread and the velocity of money versus cash flow, a development can be a very powerful tool for creating wealth very rapidly. But you have to find the right people. Once again, it comes down to that.
Well, listen, I think you just gave us great information on build to rent, and it's certainly one of the fastest growing segments in commercial real estate as a whole, particularly in the residential side where people are living. So definitely make sure you check out more information there. And again, if you got great value from Ruben's talk today or in our conversation, make sure you check out his show. You go to capitalraisershow.com. Ruben, we're going to go to our round of insights. Are you ready?
Oh, cool. Let's do it.
All right, give me a failure or an apparent failure that sets you up for later success.
Way back when I split up with my first fourplex partner, we weren't syndicating, we were just doing JV stuff. I had kind of developed the same skill set as him, which is acquiring properties and, like underwriting, very simple underwriting of fourplexes. And he's like, hey, dude, you raised 600,000 on YouTube. Why don't you get into marketing? And like, he was not prepared for how crazy I was about to go, because we were going to do a drip campaign and a conference series. And I flew someone from San Diego out to start filming a pilot that we're going to pitch to A&E. And then he started not showing up. And that's where we started butting heads. And we had an ugly breakup. And if I had just focused on the things that I was good at both, but if I had just been able to do the same things as he was doing, which is finding and acquiring and raising capital for fourplexes and not getting so crazy about the marketing stuff, who knows? That dude and I might still be partners today, taking down fourplexes. And the biggest lesson that I learned there was like, if you can figure out a way to smooth over tensions in a relationship, you can maintain a business relationship. And on top of that, if you can't figure out a way to maintain that, like, don't go into life saying, I never want to have a business partner ever again. That was sour. It sucked. I want to do things on my own, because that's going to make you stagnant. You're not going to be able to scale as fast without a team, without partners. So my biggest advice to people that are not wanting to partner with people because they want to do it all themselves is you have to change your mindset and realize that this syndication game, it's a team sport.
Love it. All right, give me a digital or mobile resource you recommend for your business.
For my business? What do you mean? The build to
app
rent
or
stuff?
digital resource you like for what you're doing in general as a whole. It could be for the Capital Raiser show, it could be for build to rent, could be for
Okay. I'll go with Kindle.com, right? If you don't want to have physical copies of books, Kindle is a great place where you can read everything from personal development to stuff on construction and real estate development, and all kinds of syndication books and business strategy books and just regular development, entrepreneurial development skills too. So that's a go-to resource for me.
Speaking of books, give me the book you've recommended or gifted the most in the last year.
The one that I gifted the most was The Science of Getting Rich. I give that to a lot of the people that become guests on the Capital Raiser show. The most powerful book that I've read this year is by Napoleon Hill. A lot of people have read Think and Grow Rich, but they aren't aware that he's got like 30 books. And I was recommended one by Zach Haptonstall. He told me to read How to Own Your Own Mind, which is kind of like a podcast interview between Napoleon Hill and Andrew Carnegie, where he basically inquires about the skill sets and most powerful tools that the most successful entrepreneurs in the history of, his time era, what was it that they needed to do and implement. And How to Own Your Own Mind is an incredible resource that I highly recommend. It will tell you that you have to work hard. So if you want to do the whole who, not how, Dan Sullivan, Ben Hardy thing, you have to realize, at least if you follow the philosophy of Napoleon Hill, is that you have to work hard too, which I think a lot of people don't want to swallow that pill, including myself. But now I realize, like, I have to outcompete some people. I mean, this is a cutthroat business. Syndication is not for the faint of heart always.
Right. Give me a daily habit that helps you stay focused on your goals.
Reading my intention statement. So I created an intention statement when I read The Master Key to Riches by Napoleon Hill way back in August of 2003, which started off as a little paragraph and now it's 17 pages. I recorded it. It goes over like everything from all of my goals, physical, spiritual, mental, emotional. And I spoke to a personal development coach that helped me incorporate and integrate the heart model, right? Because it's not like, here's all the things that I want to create and, like what I'm willing to offer in exchange for that. But like, this is why I'm worthy of it. And this is like how I become in tune with like being confident enough and having the self-esteem to do these things. And you have to, as a syndicator or entrepreneur or salesman, manage your emotional state. And if you're never looking at these things and your compelling reasons to why you want to accomplish them, you're going to be at a disadvantage compared to the people that meditate, that do the miracle morning, or that read an intention statement every day.
I love it. Give me your number one insight for raising capital.
Make friends, I think, is my favorite thing to say. Become omnipresent. I think I'm more of the mindset that, some people will say you only need 10 to 15 investors that you have a really good connection with. And other people will say you need to build a platform that is expansive, right? When you get onto people's stages and you're recognized and your funnel is massive. And then from that funnel, you can whittle it down to people that you really connect with. But right now, because people are holding on to their money, I think it's a great time to build systems, to build exposure, to build branding, and to get your name out there. So I would say be of the mindset that instead of trying to raise your percentage close rate from 10% to 20%, figure out a way to get in front of 1,000 people. So that's something that I learned from Hunter Thompson.
Great points there. All right, let's lighten the mood. You are in Phoenix. Give me your favorite place to grab a bite to eat.
Right now, there's a little restaurant called La Piñata where we have all kinds of tacos, and there's this one particular plate called this Nachos Supremos, which is like, if you go there for a happy hour, it's an incredible deal. It feeds 2 people for like under $15, and it's like the best, most delicious Tex-Mex version, because it's not, if you talk to a Mexican, they'll be like, that's not authentic Mexican. It's still so good though. The shredded beef, man, and chicken is so good. Anyways, that's my recommendation here. La Piñata on 7th Avenue in Missouri.
All right, I love it. We'll make sure we put a link to that in the show notes. Ruben, always a pleasure talking to you. You gave us some great insight. Love hearing about your background and how you went from focusing on those 4 plexes, ultimately, taking that time in Mexico, coming back, realizing that you wanted to go a little bit bigger, getting into syndications, focusing on capital raising. And I really enjoy you talking about creating that interview-based thought leadership platform, going from your time on YouTube to creating the Capital Raiser Show, getting over 2.8 million downloads, which I think is super impressive. And just how you leverage that platform to continue to grow and scale. Right now, as you're kind of navigating your next investments, still focusing on build to rent, but also looking forward to exploring more opportunities in the future. We certainly will make sure we stay in touch with you, and I advise other listeners as well, if they want to learn more, to connect, check him out at capitalraisershow.com. Ruben, thanks again for being a great guest and coming on Multifamily Insights. We look forward to staying in touch with you and hope you have a great day.
It's been a blast, man. I really appreciate you for having me on.